I'm Jerry Ellenberg. I'm chairman ERC Communities. I am indeed also chairman of Golf Suites. Uh, I'm a rare commodity. I am a guy who has two live reggae offerings out right now, and in very easy to discern different disciplines. I am a California native. I'm a California licensed CPA. I practiced in that discipline for about a decade and a half, and then went into real estate development, syndication, and the manufactured home community business. Got out of that a couple decades ago and have goofed around in hotel business, home building, so forth. And in the last 2 or 3 years, settled into these two businesses, very distinctly different. As Ramez said, there's a taped webinar, and there's all kinds of data available on the golf company. Which is essentially a retail experience, a very fun golf entertainment sports bar facility chain that we're developing and operating nationwide. Conversely, and I use the word conversely because this is about 180 degrees away from Golf Suites, is ERC Communities, a company that follows my resume much more closely. I am, if you're asking, you got one word to describe yourself, Jerry, over the last few decades, we'd have to use the word landlord, because that's basically what I have done. This is a company that is developing and will operate on an aggressively growing plan, a chain of manufactured home communities wherein we will buy land, we will fully develop that land. Developing means we will clear the land, we'll landscape it, we'll road it, we'll underground utility it, we'll bring in brand new manufactured homes, all approximately 1,400 square feet, 3-bedroom, 2 baths, and we will rent those homes out. These rental communities are meant to compete with two major sectors of housing. Number one, traditional garden apartments, where we will be renting square footage to these tenants for hundreds of dollars less than they will pay in those apartments. And it is meant to compete with traditional build for rent, stick build, conventional built homes, which are renting for even more than the apartments are. We kind of fell into this opportunity, and it is a very unique one because in the manufactured home community sector of this country, that sector is primarily dedicated to collecting rent from homeowners. A developer like us buys land, develops the land, moves in these homes, and then sells them, and thereby collects rent from homeowners. We are not doing that. We are going to retain ownership of the homes, and on a statewide scale here in Florida, then branching out throughout the Southeast and then going nationally, we're going to build a robust chain of these properties and offer non-government subsidized, fully private, real nice, independent, separate living, most likely for young emerging families awaiting their first home purchase. We think these families will on average live in these communities anywhere between 2 and 5 years, and then they'll be off to buy their new homes. We have great construction skills in the company with my partner, Ryan Koenig. We have great land acquisition skills with me and Ryan. And then we have, what I guess I would have to call pretty good financing capabilities on my behalf. So we're a very good mix. My partner, Ryan Koenig, who's the company president, has about 650 million of construction completions on his resume. Very complex buildings, hotels, apartment buildings, office buildings, hospitals. And so this level of construction that we're doing is pretty much an intellectual downgrade for him, which thereby allows a vast array of multiple developments. So that is what we're doing. What is our next slide here, Ramez?
Jerry, you just jumped straight into Golf Suites. And I was trying to say, by the way, I saw that picture of you right over here. How long ago was this taken? Be honest to everybody.
I would think that picture looks like it was taken 10 years from now. I can't stand that picture. That wasn't Golf Suites. I'm talking about ERC here.
Yeah, you are talking about ERC, but I was looking at the ERC picture and I was just like, Jerry looks a lot younger in this picture. And I mean,
I hate that picture. Get rid of that picture as fast as you can. I don't know if I look much better in this webinar. What I like to do is this. I've done a handful of these webinars, and many of them with Remez, and I'm going to give a very serious pitch to Remez and the IRA Club here shortly. We have a very, very close relationship with them. I think that we have all these slides, and they all look great, and they're very professionally prepared, but I tend to try to get you to look kind of macro down to micro. What is it that you're trying to do here? Well, you're trying to build wealth. You're trying to minimize risk, maximize reward. And how are we going to do this? The first thing you need to do is pick a sector. Today, we're talking about real estate, more specifically rental real estate. You can pick biomedical, you can pick high tech, you can pick crypto, you can pick, hospital, apartment buildings, you can pick 100 different things in which to invest. I would parallel IRA Club's generic advice to clients like you that obviously you want to portfolio diversify, you want to asset allocate, don't put all your eggs into one basket. When it comes to real estate, it seems to me that the first thing you'd want to look at is the economic side. I always go to the economic side first. And the economic is a supply-demand issue. Where are things in high demand and in short supply? Well, if you've been following anything about housing, anything about rental, you'll know that rentals are off the chart right now. Home prices off the chart, even though they've settled down a bit, and with increased interest rates, the fact that prices have come down, interest rates have gone up, homes are still expensive. Young America, late 20s, early 30s, going into mid 30s, late 30s, having a very difficult time getting into their first home. And at the same time, they start a family, they're not too inclined anymore to want to walk up to the third floor and have a 100-yard walk to the car. So we're offering them independent, separate living with their own backyard, 3 bedrooms, 2 baths, 100% brand new, probably on average here in Florida, $400 less per month than they're going to pay in a garden apartment, $600 or $700 a month less than they're going to pay for a home. And that is a meaningful savings for these people. That's the economic side of what we're doing, a supply demand. Now let's talk financial. And by the way, that is the left-hand side box there, affordable housing. That's the supply demand box. Now we'll talk financial. When we go to financial, we're not talking about economic theories of why we invest in something. We're talking about what are we going to get? What do I get out of this? That's financial. ERC Communities pays an annual 10% dividend to its shareholders. It pays it every quarter, so that's 2.5% per quarter. You do a $10,000 investment in our Reg A, you get a $1,000 annual dividend, and you will receive it $250 per quarter. You can take that dividend by check. You can take it by ACH. And now we're working on, I think we're getting pretty close to being able to offer our investors the ability to reinvest the dividend. We're not there yet. Our investor services director is working on that right now with our transfer agent, our broker dealer, and a lot of gimmicks to get that all fixed and right before the SEC. But we should be able to have people reinvest dividends, which a ton of people want to do. We think that is particularly attractive to IRA clients because the dividends go into your cash account at the IRA facilitator anyway. And so since you're not going to get it, you may just want to leave it with the sponsor and increase your share count. But that's obviously your decision. The second feature, and it's not on here right now, but it's okay. And this, when I hit this, well, yes, it is. My picture is blocking it. It's on the right-hand box. You see preferred stock. That term preferred stock is one of the most important terms you're going to hear in our offering. And I ask people on the webinars to go to Google and look up the definition of preferred stock and then look up the definition of convertible preferred stock. Simply put, preferred stock is first money out. So we go to sell these communities in a couple of years, 5 years, 10 years, whenever. Whatever your investment is in your stock is the first and only money that gets paid out before us common shareholders share in profits. Once again, look that up on Google, look it up in a dictionary, and feel free to contact us. We are quite available here. We have a couple of different phone numbers on the webinar itself. We're very easy to reach, but you really need to understand and appreciate the concept of preferred stock to have truly any interest in this investment. So
think we lost Jerry. Jerry, can you hear me? Jerry? Sir? I think we just lost Jerry for a second. Let's just make sure. He may have logged out on accident. Let's give him a second to jump on board. Again, for those of you joining us Jerry, please forgive us. We lost you for about 15 seconds.
It says my internet is unstable here. Can you hear me now?
Yes, I can. If you just want to go back about 10, 15 seconds, we lost.
See, I think what I was saying is that you have a conversion option. I often get asked what will happen with this chain of properties. We'll either sell it, we'll merge it, or we'll do an initial public offering and go public. In any of those situations, you will be given the choice of converting to common stock if that value is higher than your preferred, but you will never receive less than your preferred. I then think that what I said was feel free to contact us, because when I get into convertible preferred, we're getting into 13th grade issues there. We're getting a little off the main frame of this webinar. It's a little more of a sophisticated one-on-one discussion, which I'm happy to have with anybody. But again, preferred stock, first money out, tax deferred, 10% annual dividend. We've now paid that for a couple of years, and you are going into affordable housing in an acute undersupply and over demand scenario in as many as 10 or 15 states into which we're looking right now. Let's see the next slide. I have a feeling, as I probably breezed through some of these slides that we haven't seen yet.
You're good on time, just an FYI.
Well, this, what is ERC Communities? I've already said we are a developer and owner operator, build for rent, manufactured home communities. We are literally breaking ground. We're running drones right now, filming the ground break on our first 165 units out here east of Tampa in a suburb called Zephyr Hills. We're going to start putting in underground, all of our underground sewer and paving and getting this site ready for delivery of homes. Our activity is indeed the sourcing of land, which means, finding land, buying it, developing it. And then, of course, the horizontal construction, which is primarily the bringing in of the manufactured homes that we buy from various different factories. These homes are trucked in and then they're assembled to the ground in place. So that's what ERC Communities is. Go ahead, Remis. Again, I think I've already hit on this. I have a tendency to kind of get ahead of these screens. The market dynamics, this is an interesting sourcing. Clearly, COVID came into play here. As we came through 2019 into 20, COVID hits, all kinds of new dynamics start occurring. The migration to the affordable states, like those of our states here in the South, Florida, Alabama, Texas, everything in kind of the Southeast quadrant has put tremendous employment demand, thereby tremendous housing demand. And so there's just been an unbelievable, compelling opportunity and growth in this build to rent area, because a lot of these families moving in either don't want to or can't afford to buy right now. I mean, rental properties have been around for centuries. What we're seeing a move away from is the baby boomer generation, to which I belong, and even the generation after me, very heavily oriented to home ownership. On a cultural basis, that seems to be waning away a bit now. And newer generation families, late 20s, 30s, early 40s, are opting to invest in active investments instead of a personal home investment. So you might even have an affordability to buy homes, but families are doing that less and less than they were. The rent savings I hit on. We just today got our renewed feasibility study on our initial sites out here at Zephyr Hills. Our rent projection went up 17 percentage points in 15 months, if you can believe that. That's 1% a month. The rent projection went up. And in the feasibility study itself, which we're using for institutional mortgage financing, the feasibility consultant said, quote, "We have no way of projecting how these rents may continue to increase over the next couple of years." So it's extremely strong demand asset type. Go ahead, Remis.
I should also want to bring something up to most investors. And I think that Jerry brings up a great point. So you don't anticipate, right, what it's going to go up to, right? He said 17%. But when you look at history and historically, when you look at rental income, right, it has never dropped in 30 years. It may flatline or stay stagnant, but a year or two, but historically, it only goes in one direction, and that's up. So it's one of the best ways to protect yourself against, market volatility, the inflation, anything that you could think of outside of what's currently going on. The best way to protect yourself is a hard, tangible asset because of that simple fact that Jerry just brought up to you. Go ahead, Jerry. I'm sorry to cut out.
Well, again, a lot of this is kind of repeat. I mean, I've already said we are focusing on manufactured home rental communities. ERC Communities One, which is our Reg A entity, will exclusively do this. I got to be careful in these webinars to not go too deep. The volume capability here might be hard for you on the webinar to understand this, but we're building a 165 unit development in Zephyr Hills. We also look like we're buying 90 units of land about 5 miles away. We're looking at land out down in Sarasota County, south of us, for 350 units. So you might say, geez, how do you do 165? How do you do 90? And how do you do 300? There's a vanilla, I hate that term, but it really is. There's a vanilla aspect to what we do in preparing sites, in doing underground, in ordering the homes and bringing them in. And frankly, there's greater efficiencies the larger these communities are. And in investing in this, again, looking at the risk side, you're essentially investing in a management team that offers you a much lower risk profile than you might have in an alternative, in any of the other alternatives that you choose. Homes are manufactured off-site, underground. HUD and FEMA inspected every single one before they leave the factory. We are not responsible for anything vertical. There's about a dozen trades, everything from foundations to roofing to sheetrocking to electrical, plumbing, tape, texture, paint, appliance installation. All of these things fall away. And as an investor, you can look at this, you can look at ERC Communities and safely say to yourself, I'm investing in a lower risk profile. And at the same time, that lower risk, given the perceived quality of this management team, allows for a much broader escalation of growth. I frankly think we could have 4,000 to 6,000 rental units in the next 4 to 5 years, which is a very conservative goal of mine. And that would lend itself to a very nice exit strategy, most likely a REIT merger. So, I'm condensing what you see there. This thing about 60 homes, that is pretty much the minimum. We can't really be efficient under that size. My partner, the company president, loves 60 units because it's kind of so easy to get his wits around. But he kind of has to answer to me when I push him to larger size. I think on average, if we wake up 5 years from now, look back, we'll see that the average unit site probably came home around 200. That's an extremely efficient sweet spot for us. In that unit size, we can afford to kill some land for a swimming pool, maybe a little softball field, stuff like that, which you can't do on smaller sites, which very, very, very key features for family residents. I touched on target markets. That's basically the 3 o'clock to 6 o'clock side of the map, the United States. This is probably most likely where you're going to see us go. It's hard to say. We could get a call on a piece of land in Boise, Idaho that we like. We could get a piece of land in Spokane, Washington, Minneapolis, Minnesota. I mean, we just don't know. We use the word target. Target, what target means is where you aim. Doesn't necessarily mean where you hit. So I can't say for sure where we will definitively be, but this is where we're going to attempt. When I ran my manufactured home chain, I think we ended up in 26 states. And so we have a tremendous interstate immunity here. We're not intimidated, both in the golf company and ERC. We're very unintimidated relative to interstate commerce, where we operate around the country. We know the nation pretty well. Florida is just such a unique opportunity right now. Let me give you a little example of that. Ryan Koenig, the company president, and I were at Pasco County a couple months ago, the Economic Development Council. I'll make a very long story short. They took great interest in a television article, a television spot that Ryan was in about our Zephyrhills project. They filmed us both. They cut me out completely and put Ryan in. So you folks are getting second string here today with me. But anyway, that this TV spot went on. And so we went in to see the county. And at the end of the meeting, they asked me, they said, Jerry, when will your first units be ready? And I said, well, I think we should have homes come in around March. And, once everything is done on the first site. And he said, well, will you call? And I said, well, sure, I'll call, but why? And he said, well, we probably have 2,000 or 3,000 applications for you on your 165 units. And I was just flabbergasted. The county in which this Zephyrhills project sits is losing business. Companies are deciding not to come to Pasco County, which they really want to do. Access to the ocean, weather, access to Tampa Metro. I mean, various reasons why to go to Pasco County, affordability. They're losing business to other counties in Florida now because they don't have any housing. So a boss calls up, I'm going to do a warehouse, I'm going to do a back room call center, I'm bringing in 400 families. What do you have? I got 100 homeowners, I got 300 apartments. What do you have? And the county says, we have nothing. We have nothing. And so they're just all over us on this. I'm telling our mortgage bankers on this that we're going to start our rental promotion program on Feb 1. My guess is we'll have 100 approved, signed, and bank deposited leases on this site within 2 months by April 1. I'm going to be extremely disappointed if we don't have that within the first 60 days. That happens to be one of my skills. We're putting that team together right now. So we are just extremely bullish. This asset has a very high yield when plotted against the mortgage rates we're going to have to pay. That is, of course, how we, accrete these dividends to you folks, and great growth potential. We Remez, as you know, we do kind of an advanced webinar where I talk about yield and leverage and talk about, cash flow in excess of the dividend. I don't think we can get into that today, but that if the IRA Club folks want to do that, I'm delighted to go to kind of a 12th grade level here, which is the real beef of what makes this work. The leveraging, the excess yield over mortgage rates and those kind of profits being reinvested along with new share sale capital. We can do that if IRA Club would like.
Well, we typically, what we do with these webinars, just so everybody understands, is we want you to learn something outside of the norm, right? Outside of stocks, bonds, mutual funds, as you always hear me say. So when you want to get into a more in-depth conversation, I would always encourage that you reach out to Jerry and his team.
Informed decisions. Just make sure you know what you're doing. We are a company that'll answer the same question 10 times if you want us to. You can't ask too many questions. And there have been times when we've talked with people and I've actually gotten on the call and said, I don't think this is right for you. That can happen once in a while. So we're, of course we want you investing in these companies of ours. We love what we're doing. We love what we see in the future, but just make sure the decisions you make in investing are informed.
Jerry, it's always a pleasure talking to you, sir. And your words of wisdom to me, I always listen to everything that you got to say. And I actually do reach out to you when I do have some general questions about Reg A's. So thank you always. Okay. Everybody take care until.
Thanks, everybody. Thanks for joining.
Thank you.
Okay, take care.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.